Many people look forward to their retirement where they don't have to work at their 9-to-5 jobs anymore and have the money to travel or do whatever they want. With the main source of income stopped, most will be relying on income from their Social Security or pension or IRAs. In this video, we will take a closer look at the three most common types of IRAs. They are the traditional IRA, Roth IRA and 401k. IRA stands for Individual Retirement Account. They are retirement accounts that the U.S. government has established rules and policies on it. Here are some general rules that apply to all types of IRAs. These are retirement accounts, which means you can only withdraw money from these accounts after reaching age 59.5, otherwise, there's a 10% penalty. There are some exceptions to the 10% penalty rule. The yearly contribution limit is a combined total of all your IRA accounts for the year. In order to make contributions, you need to have earned taxable income equal to or greater than the contribution amount. Depending on the type of IRA, there are also income limits as to who can contribute or if the contribution is qualified for a full or partial deduction on your tax return. Let's take a look at each type in more details. Let's first look at the traditional IRA. Traditional IRAs are pre-tax retirement accounts, which means the contribution's not taxed when you make the contribution, but will be taxed later when you withdraw the money after reaching age 59.5. Contribution limit for 2025 is $7,000. If you are 50 years or older, your contribution limit is $8,000. You need to have earned taxable income in order to contribute. Withdrawals and distributions are taxable. If you withdraw money before reaching age 59.5, there's a 10% penalty. However, there are some exceptions to the 10% rule. Please visit the IRS website for a full list of those exceptions. There's also a required minimum distribution, RMD, withdrawal at age 73. Depending on your modified AGI income, your contribution is fully deductible or partially deductible. The deductibility of your contribution also depends on whether you have a retirement account at work or not. Here are two tables from the IRS website showing the modified AGI income limit for the deductibility of the contributions. Look at the table on the left if you have retirement accounts at work. The table on the right is if you don't have retirement accounts at work. I encourage you to check the IRS website for more details. Next, let's take a look at the Roth IRA. Roth IRA is a powerful tool as a savings account for retirement. Why? Because when you take the money out, and you meet all the requirements, all of the money inside the Roth IRA account is tax-free. Imagine having $5 billion tax-free. That's what happened to Peter Thiel's Roth IRA account. Peter Thiel is the co-founder of PayPal and other startups. I encourage you to read upon the story about how Peter Thiel grew his account into $5 billion by using his Roth IRA account to invest in startup companies. It's a really fascinating story. Anyways, let's take a look at the features of a Roth IRA. Roth IRA is an after-tax retirement account, meaning the money you use to make the contribution has already been taxed. Your Roth IRA contributions are not tax-deductible. The contribution limit for 2025 is $7,000 or $8,000 if you are over the age of 50. Remember, this amount is a combined total between Roth and traditional IRA. You can put all of the $7,000 in either one or split the amount between the two types. One of the drawbacks of Roth IRA is that if you're a high-income earner, you might not be able to contribute if your modified AGI is over $146,000 for singles or $230,000 for married. One of the method high-income earners get around this income limitation is something called backdoor Roth IRA, which I will talk about it in more details later in this video. One of the biggest advantages of a Roth IRA is that the money that grows inside this account is tax-free when you withdraw the money after reaching age 59.5 and have held the account for 5 years. Doesn't matter if it's $5 million or $5 billion, it's tax-free when you meet all the requirements. Other benefits of Roth IRA are that there's no minimum distribution requirement and you can leave amounts in the account as long as you live. Also, you can transfer your Roth IRA to your heirs after your death if you name them as beneficiaries and you have held your account for 5 years or more at the time of your death. However, your heirs have to withdraw all the money within 10 years. As you can see, all the benefits a Roth IRA offers, they are the reasons many preferred Roth IRA over traditional IRA given a choice. Here's a table from the IRS website regarding the AGI upper income limits for Roth IRA contribution eligibility. Please visit the IRS website for more information. As I mentioned previously, many high-income earners can't contribute to a Roth IRA because their income is over the limit. To get around this rule, there's a loophole that can get around this income limitation, and it's called a backdoor Roth IRA. What is a backdoor Roth IRA, you might ask? A backdoor Roth IRA is essentially just converting money from a traditional IRA or 401k to a Roth IRA to get its benefits. Unlike the Roth IRA, there's no income limitation to contribute with a traditional IRA or a 401k, you just need to have earned income to contribute. This method is all totally legal, and many people have used this strategy to maximize their retirement accounts. The conversion has to be completed within 60 days. One of the huge drawbacks of this strategy is that with the amounts you converted, you have to pay taxes on them. The timing of when you choose to convert has huge implications depending on where you fall within the tax brackets. This could potentially create a huge tax liability. That's why this strategy might not be suitable for everyone. Please consult your financial advisors before doing any conversions, as they are non-reversible. And lastly, we will talk about the 401k. 401k is also a type of retirement account. The main difference from a traditional or Roth IRA is that it is set up by your employer. The contribution amount is usually deducted from your paycheck and is excluded from calculating your taxes on the paycheck. That's why it's called a pre-tax retirement account. Many employers also will match your contributions. For example, for each dollar you contribute, your employer will match 50 cents, etc. The employer matching contributions will usually have a vesting period in order to get the full amount. For example, you have to work at the company for 3 years in order to be fully 100% vested. Your own contribution will always be 100% vested. The contribution limit for 2025 is $23,500. If you are over the age of 50, you can contribute an additional $7,500. The contribution is not tax deductible, and there's a required minimum distribution at age 73. Finally, if you withdraw after reach 59.5, there's no 10% penalty. Here's a chart summarizing the main features of each type of IRA to maximize all your retirement accounts. Careful planning is required. I encourage you to talk to your financial advisors regarding your financial decisions. What I presented here is for educational purposes only and does not constitute financial advice. Thank you for watching. Please like and subscribe, and also share this video. It really helps this channel grow. Thanks again, and I will see you on the next video.